Hey everyone, today on the final bar, market recovery just a bit today, so rallying a bit into the close, selling off during the day, but finishing relatively in a position of strength, all about digesting yesterday's sell-off. So weekly charts that looked a certain way after Monday's session of a follow-through to the upside, looking dramatically different now. So today when we wrap the week, it's all going to be about looking how Friday's close now that it's locked in. What does this mean for the big picture trends? What are we expecting next week? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar on a Friday afternoon. This is Dave Keller, your host. I'm the chief market strategist here at StockCharts.com in a somewhat rainy Redmond, Washington. Thanks for joining us every weekday after the close to make sense of these markets from a technical perspective. No better time than a week like this one to focus on the charts, because as much as things have changed, as much as the week has been volatile, the charts will help you identify where the trends are, how the trends are changing. And to be honest with you, I've had a lot of debates with my peers in the industry this week as we've digested a market going to new highs on Monday, all of a sudden new swing lows on Thursday, everything in between, volatility spiking back up, the VIX increasing dramatically going into the end of the week. So a lot of volatility, a lot of movement. But again, this is when I think charts can be the most valuable, because it helps you, define some lines in the sand, define your risk, understand where you feel trends are in place and where you think you need to reevaluate them. Charts, if used correctly, can really help you manage all of those things. So hopefully we'll navigate this together, see how Friday's close evolved the picture from the week. Now, we had a series of fantastic guests this week helping us give their take on what they're seeing using their toolkit. Next week is no different. We've got some great guests for you. On Monday, our next episode of Behind the Charts features Mike Turner. Mike's more of a quantitative money manager is how I would describe him, but uses a very technically oriented toolkit as he manages his funds and writes his research. So a really cool opportunity to learn from someone like that who's developed a rules-based technical strategy. Then on the final bar on Tuesday, we have Jeff Greenblatt. On Wednesday, Jay Pettit. On Thursday, Bruce Powers. And then again, coming up mid-July, July 13th, that entire week is called Charting the Second Half. We're creating some really cool events for you, special guest presentations. All of our stock charts commentators are going to be involved. All the shows are going to have a bit of a market outlook feel to them. We'll finish the week with a really cool market outlook panel talking about the second half of 2020. So mark that off the week of July 13th. Let's attempt to wrap this week, and wrapping the week. It's a 10-minute phase on Friday at in the show is plenty of time, I feel like, to define what's happened this week. I don't know if we have enough time in an entire day of programming to try to make sense of this, but we'll do our best. Wanted to start out with a poll, actually. We asked you on StockCharts TV and also on our YouTube channel over the last couple of days, what basket of stocks do you think will perform the best over the next month? And I gave you four choices. The FANG Man trade, which is sort of the FANG, the MAGA sort of mixed all together, Facebook, Amazon, Alphabet, Microsoft, and NVIDIA, all of those. Biotechs, things like Regeneron, Biogen, and so forth. Banks were number 3, JP Morgan, Bank of America, Citigroup. And then energy, Exxon, Chevron, ConocoPhillips. And the results are in. Over half of you, just over half, said the FANG Man trade, that big defensive mega cap tech and communication services basket of the stocks that have been leadership for quite a while on a relative basis, for sure. A quarter of you answered biotechs, things like Vertex and Regeneron, and 10% each for banks and energy. And it's interesting, I guess, depending on when you answered that poll during the week, your answer may have changed dramatically. And I don't have the transparency to know when when the votes were given and where they lean to. But over half of you, I think, picking what is a pretty decent bet. I think what's been impressive with stocks like Microsoft and Apple, we've highlighted on this show, they've continued to do well. And even when the price has pulled back on a relative basis, they continue to outperform. And, again, looking at the XLK and just the long-term trend of it, when charts like that just continue to chip away on a relative basis, and in upswings and downswings, they do well. It's not a bad play, especially if you're nervous. That makes sense. If you're optimistic, they've been leadership names as well. The relative strength have been pretty consistently positive. So I will assume you've come to that conclusion looking at the charts, and for that I say job well done. Within biotechs, things like Regeneron have consistently been at the top of the scooter rankings. Regeneron right now the third on our entire list of 1,000 plus large cap names. So decent bet as well. Banks and energy, I think, are a tough play, to be honest with you. And if you would vote one of those, you're expecting that this sort of rally that we saw up until the end of this week, up until Thursday, that would continue. You'd continue to see banks and energy that have been, really emerging as new leadership, but now have corrected. You'd assume that outperformance would restart. I don't know if I'm getting that feeling looking at the charts. Let's look at some of these together and see if your opinion would change over the course of this wrap the week segment. Just to reset on where the day finished and where the week finished, the S&P closed a little bit higher to 1.3% higher to 3041. So if you look at just the day, this is yesterday, just look at that slow and steady downtrend, just consistent down move. We gapped higher today, but then pretty soon, by about 11:30 a.m., we were right back at the previous close. We gapped up, but then gone all the way down and round trip to the lows. We actually poked below there after lunch. Around 2 p.m. was the low of the day, around 29.90. So we did rally into the close. What's encouraging about that, as we talked about in our last mailbag segment, that's when a lot of institutions tend to come in and put in some larger orders. So institutional flows are usually what you're getting a sense of at the end of the day, and certainly feels more net buying than selling going into that close. But the destruction's been done. Yesterday's sell-off certainly put us into a different feel altogether. And I just know from the commentary that I follow and my own thoughts, it's very easy to start thinking about downside risk when you've been ignoring it, when the market just continues to go higher. Now we've seen a bit of a chink in the armor, and the question is what's next. Mid caps and small caps down. Up a little further. So small caps finished up 2.5%, which is pretty nice. It was actually a nice run higher. Also bottomed out around 2 p.m. and came up to finish a little stronger. The Nasdaq 100 finishing up as well, 0.8%. So underperforming the S&P, but overall hanging in there all right. Bond market's a little weaker today. They were up pretty significantly yesterday. Choppy move today, but finished more toward the lows with the TLT down almost 1%. 10-year yields up to around 70 basis points or 0.7%. Commodities essentially flat. Gold was up just a token amount, but overall relatively mild. Had rallied pretty strong out of the open, but then came off and finished more toward the lows of the day, but higher than yesterday's close. So commodities not a huge issue. And it's interesting, thinking about cryptocurrencies. We don't talk about cryptocurrencies a ton on this show, but I think it was worth noting yesterday when risk assets like equities were down significantly. At times, I know people have talked about Bitcoin and digital assets as more of a safe haven of sorts, like the dollar that you'd flock there. But worth noting that Bitcoin was actually down pretty significantly right along with stocks yesterday, up a little bit and retraced a bit of that today, but again, finished the week weaker rather than stronger. Let's look at, let's go right to the Mindful Investor Live chart list to finish off our discussion here, wrapping the week. So, with our Wrap the Week section, the idea is to take stock of where we've evolved. And we talked about this market trend model a couple times this week, because on Monday, with the big gap higher, this is where Monday opened around 320 on the spiders, which was, up again from Friday's close. And I made the comment that if the week ended right at that moment, the long-term model, which has been bearish since, March, which was just before the market lows, mid-March when it finally turned negative, this would have flipped it back positive if the week had closed Monday midday. By the end of the week, and Thursday is what really killed it, actually remained in a negative signal, remaining below the zero line. So it's really, really close as you're close to crossing. And depending on what long-term weekly moving averages you use, it may or may not have turned positive this week. But for my model, for what it's worth, it remains in the negative camp. So would have to wait until next week at the earliest. I look at it every Friday to formally update it. What's interesting is I've not updated the chart yet, but short-term indicator actually turned negative because the slope of the histogram separating the two weekly PPOs just turned negative this week with the down close. So right now it's long-term bearish, medium-term bullish, short-term bearish, which is actually about right. That actually feels about right with the outside week that we've seen here. That's when you have a big up week, an outside week, meaning higher high, lower low, but you have a down close. It wasn't quite a bearish engulfing pattern on the spiders, which would be the close would need to be below the open from last week. So it's not quite that negative, but still is, I would bucket in the negative candle chart sort of category. And certainly from a bar chart analysis, this is called an outside week with increased range, higher high, higher low, but a down close after an up close. And that suggests short-term weakness, telling you the next couple of weeks are going to be more corrective. So I feel pretty good about a model that says short-term weaker. The medium-term trend, which is this coming out of the March low, is still stronger. That makes sense because we haven't retraced enough to feel that that's negative. And the long-term trend is still telling us we're in overall bear market territory, which is about, I think, how things feel, to be honest with you. Now, the real, I think the validation of that sell-off on Thursday cannot be overstated because, as we continued higher, we become overbought. What we talked about on the show was just, this is now, an overbought condition. That on its own does not tell you that the uptrend is over, but it suggests that we're, near that point where you'd start to look for some sort of topping signal. We got that going into Wednesday's session when you have the pullback, you have the RSI coming out of the overbought region. We then sold off obviously significantly yesterday, today and yesterday, pushing the daily S&P below its 200-day moving average. Yesterday, we actually closed below it. Today, we closed back above it. So I don't think you can count that as a valid breakdown of the 200-day. At this point, it's serving as proper support. I think for a lot of people, myself included, holding above the 200-day, holding above the 3,000 level is pretty meaningful. As long as we can do that, I think that medium-term trend remains positive. If we would start breaking that, which would have to obviously be into next week, I think that's where you have to be a little more concerned about further potential downside. At this point, though, I think at this point it's serving as support. We've traded down about to the level where you'd anticipate support in a quick pullback, which was again long overdue by any stretch of the imagination. Just to jump around a bit, and sorry, in this sort of environment, I feel like my mind is spinning with things that would be great to review. This is the NDX, the NASDAQ 100. This was one of our 3 and 3 yesterday. Give me just a second. I'm going to switch to a weekly macro chart, which is this one. The concern I have looking at the broader charts, and over the weekend, I'll love to look at individual stock charts and see how many come up. But I have a feeling with a lot of tech names and a lot of the leadership names, we're going to see a similar divergence on the weekly chart here. We've had a higher high in price, a higher close on the NASDAQ 100 the last couple of weeks, but we now have a lower RSI. And I think, it felt like we could still be going higher. I think the pullback that we saw this week could indicate that, this is sort of the short-term top in the RSI. So you have higher highs in price, lower peaks in the RSI, which is very toppy. That's sort of what market tops have tended to look like. It's not 100% totally this is what always happens, and is a perfect example that I'll show you the end of 2014. You had the bearish divergence here, among others, which was higher highs in price. You can see lower peaks in RSI. The market actually continued higher for another 6 months. Even though we had that pullback in mid 2015, we actually went to new highs at the end of 2015 before the end of that pullback. So even though while that whole stretch was corrective, in the end, you sort of resolved higher, and it was more of a time correction than a price correction. So, so again, it's not saying that means we're going to retest the lows or anything like that, but it certainly suggests that we've gone high enough for this phase, and expecting further weakness in price would be certainly a legitimate expectation based on that broad divergence. But if you look at all the broad asset classes, and NASDAQ 100 is one of the few that's moved to higher highs. The average chart looks more like this, which is the Russell 1000, the New York Composite, the Dow Transports, the Russell 2000, which is small cap stocks. You can see they all have, come nowhere close to their highs from earlier this year. The S&P 500 is the same. So the NASDAQ Composite, the NASDAQ 100, those are the two that have already made higher highs. Interesting to see that they've gotten that divergence. And now you have a non-confirmation with the broad indexes, the S&P not making a higher high while the NASDAQ Composite did, which again sort of nets out to more of a weaker tape than stronger. This did not update for today some of these breadth measures, but I just want to finish off looking at some of the breadth readings. Here we're looking at the cumulative advanced decline lines. Yesterday's sell-off was certainly very, very sudden. This short-term uptrend that we've seen since the March lows, I think, still in place, right? If you look at a trend line taking the lows, we're still overall making higher highs and higher lows. All we've done here is begun the process of making what arguably could be a higher low. We'll have to see what next week holds. So overall, it's not flashing a warning signal yet. So breadth, I think, still remaining fairly constructive. A lot of the new highs that we saw going into this week have sort of dried up. So you can see the increase in new highs on the S&P 500 going into this week. You can see how it's come off as a lot of stocks obviously pulled off of their 52-week highs. To wrap up, though, here I want to focus just on this form of breadth, which is the percent of stocks above their 200-day and above their 50-day moving averages. We've looked at this chart a lot, and a lot of my guests in the last couple of weeks have referred to a chart kind of like this, which is looking at how many stocks within the benchmark are confirming what we see with the overall market. So the S&P breaking above its 200-day in the last couple of weeks, now testing it from above. What is the average stock doing? And what you saw is it went from a single-digit percent of stocks above their 200-day to almost 70% of the S&P above their 200-day. That has very quickly come down to 36%. So we've lost about 30% of the S&P that had been above their 200-day, now closing back below it, going into Friday session. So that sort of change is obviously very, very key, and it shows you how many stocks are in that similar bucket to the S&P, just recently breaking above the 200-day and now coming back below. They're right at that key point. So whether stocks like those stocks that are making that switch, whether they're able to recover into next week and go back above, or whether this is the beginning, if that line continues down, showing you more stocks breaking down into next week, I think that'll tell you certainly a sign of some weaker breadth going into next week's trading as well. We need to take a quick commercial break. Back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the show. This is your host, Dave Keller, here at StockCharts.com. Thanks for joining us every weekday for the Final Bar. We're going to get into our mailbag segment here in a moment. Just as a reminder, we love to hear from you. We get so many great questions from you trying to use charts and answering the questions that come up in the normal process of managing your positions, managing your portfolio. So just remember, we're here to help you and enlighten, challenge your thinking, and hopefully point you in the right direction as much as we can. Just shoot us an email anytime, thefinalbar@stockcharts.com, or tag us on Twitter with any sort of comment at FinalBarSCTV. We'll gather all of those and maybe answer one of your questions in our next mailbag segment, middle of next week. Let's open the Final Bar mailbag, and I'll try to get through as many of these as I can. Again, some really thoughtful questions, and a number of you are sending charts along with it, which is really helpful. I can see exactly what you're talking about. Let's go with question number one. Love your thoughts on Lowe's chart since the March low. So I have it up here on the screen, daily chart with RSI and with on-balance volume at the bottom. Chart since the March low has been great. Higher highs, higher lows, recently met to new highs. RSI and the on-balance volume confirming that continue to go higher. And I totally agree. Coming off the March lows, Home Depot lows have been some really attractive charts. Just a nice run out of the lows. Relative strength has been pretty decent, and both breaking above their February high. So I 100% agree with what you said so far. Do you see it as checking back to the trend or rolling over? I see it seems to be cooling off in the last couple of days. Yeah, I'd say that's fair. And it's funny. I think you asked this question before Thursday. I think this came in like Wednesday. So yeah, the picture may have changed a bit since you asked your question, but I think the question's still valid. What's interesting when you look at a chart like Lowe's, when the market does what it's doing and when the market pulls back, which is totally normal even in a consistent uptrend, the stock just doesn't go straight up. Even Lowe's has had fits and starts, impulse moves and corrective moves. So a corrective move right about now is totally fine. And Lowe's could go to the moon and keep along that pattern, and it will be a totally fine uptrend. So, it's easy to get spooked out. But remember, I think what's key is to pay attention to, I always talk about like a line in the sand, like what's that level at which you would revisit something. And I think a lot of stocks are testing their 200-day moving averages. A lot of stocks are testing previous swing lows. I think with something like Lowe's, Microsoft, Apple sort of names, things that have already broken to new highs, we're now retesting that previous high from above, right? So lows topped out in February. Really, the topping process seemed to start in January, sold off, went to new highs, and now it's pulled back. And this could go, of course, one of two ways, right? This is the pullback, and one of the best patterns ever is you break out, you retest, and then you continue higher. And if you're nervous about that, or really a break to new highs, a break to above the June high from the first week, would be that validation that that has occurred and that we're breaking, further on. And that's when it would make sense to, consider a new position, a new long position or something like that. But you also want to consider the potential downside. I think we're right at step one, where if I'm holding this, I would be thinking this is right at support. If you break below that level, I think that's sort of your first level. And I've seen people, that are more aggressive take some off the table. I think the next one would be down here, which is where, you're looking at the May lows, which is really the last swing low. This is the 200-day moving average, the 50-day moving average, all around that sort of 108 to 110 area. So that's a bit of downside you would stomach. But again, that would be the next level. That would be sort of the, point of no return, that if stock breaks below that sort of support, I think you have to really consider, potential for much further downside. It's also coming out of an overbought region, which with many stocks, similar sort of thing. So that's sort of how I would think of that level. I think we're right at that key decision point going into next week as to whether we break that previous high or not. Next question, what is more useful, chart patterns like bases, ranges, and double tops, or candlestick patterns, dojis, shooting stars, and golfing patterns? Can you rely on one more than the other? It's a really good question. And I actually use both. You hear I don't use a ton of candle charts when I'm referring at them during the show. And to be honest with you, that's more for time reasons. I usually have bar charts up. I've used candle charts a lot, especially if I'm thinking more tactically, if I'm looking more at short-term movements. I found candle charts to be really, really helpful. I think the thing you have to remember is that the things you asked about can actually be used together, and I would argue they're both meaningful. The time frames are very different. Candle charts in general are very short term. So when you see a bearish engulfing pattern, that's really only telling you about the next couple bars. That's not telling you something huge, like a huge dramatic change, right? A bearish engulfing pattern doesn't tell you the ultimate top is in, the stock's going to go down 50%. It just tells you in the short term that there's more selling than buying, or more supply than demand, and that the short-term prices are weaker. So I have actually found using the two of those together can be really helpful. It's breaking out of a base, and there's a key candlestick pattern. It's testing resistance, which would confirm a breakout, but there's a bearish engulfing pattern at the resistance level. That is a really good way of combining the two and maybe finding a way to invalidate the breakout because you see the candle pattern emerge. A lot of times around moving averages, a hammer candle right at the 200-day moving average comes to mind as something that could be really compelling. So it's combining more of the long-term, the pattern, the chart pattern, with the short-term, the candlestick analysis. So I would say use them together. For me, I tend to think a little more longer term, and so I'm using patterns more often because of that. And I think of support and resistance as being the main expression of that. Great question. Question number 3 was on RRG, and I will do my best. Julius DeKempener is certainly the authority. It's his creation, but I've used it for quite a while, and this is the one you were asking about. The XLE doesn't make a ton of sense. It was down nearly 9% for the last 2 days. The RRG has it moving up from weakening. So you're talking about this down here. So again, further to the right means outperforming, further to the left is underperforming. The vertical axis gives you sort of the rate of change of that, the derivative of that, the transition, the change, the momentum in that relative performance. And when things are going northeast, that's sort of the direction of integration, the direction of positive movement. And so how can the XLE be down but going up like this? If we put this in motion, you can see that the XLE had been kind of chopping around that weakening quadrant for a little while here. And again, this is daily data. I usually show the weekly version, so this might look a little different than the ones I've shown, but you're looking at the daily data, which is fine. And then you can see it sort of turns northeast right about around here a couple days ago, and then kind of goes up here. The way you answer that question is this. Remember that the RRG is based on a set of tools driven off of relative strength. It's using basically the change in this line using proprietary calculations to determine where it fits on there. And so when I'm thinking of the RRG, I'm thinking of this sort of overall trend. So the relative strength overall has been positive. And so when you're looking at the last couple of weeks, you're kind of seeing this. So even though there's a bit of a hiccup there, it's not gotten absolutely crushed on a relative basis. If you compare it to something like, financials, which would be here, you can see how the relative strength overall had been really good and now really rotating lower. It almost looks like the entire trend has changed. Based on if you and again, I can't tell you everything about how they're created, but I would tell you it's based on things like the slope of this and the smoothing it out using moving averages and other sorts of things. So I would say just the way that energy has held up overall on a relative basis, even though it's pulled back, the relative strength overall, if I look at it sort of, cover up one eye and use it as an eye exam, overall the trend remains positive. And I think that's when the RRG, the rate of change of the relative strength still remains relatively positive compared to some other sectors for sure. That's how I would answer it. I will forward that question, by the way, to Julius, and maybe he can answer it in his own way. And I hope he somewhat agrees with what I just said. If not, I would trust him. He's the guy that designed it. I'm just using it. The last question was on the TLT. We talked about fixed income earlier this week on Fed Day on Wednesday. And someone had posted, this actually came to us on Twitter. Someone that we both follow actually had pointed out how the price of the bond prices, if you look at the weekly chart, it's going back to 2005 here, higher highs in price, lower peaks in the RSI. Does that concern you? And the last real clear comparison to that, I would say, would be 2011 to 2012, where you saw the TLT go higher. You see the bearish divergence here, and you can see that bond prices came down for the next year or so. So is that what we're seeing here? Absolutely. And I think that's a totally fair thing. For me, divergences put it on the radar. The price actually breaking down is what really confirms it for me. And I think that's what I'm looking at. Is this been enough of a pullback and then a recovery? If you think about how stocks really sold off into the end of the week, bonds actually retraced and this week actually reversed it. And it's more toward the upper end of the range for this week after yesterday having a pretty destructive week. So it's almost coming off a little bit. I think this bearish divergence is a really interesting one on the weekly chart. It's one I'm certainly going to be following. What's concerning about this is if that's true, bond prices rotate lower. That suggests higher interest rates, which is certainly not the vibe that I think we got from the Fed this week, and I think a lot of investors are expecting. So a dramatic sell-off in bonds would not be, I think, what the average investor is necessarily positioned for, which could be kind of an interesting one for sure. One of the charts I love to look at is that long-term interest rate chart, which is looking at, on StockCharts, and I'll very quickly show you. If you go to charts and tools and go to historical charts, which are down here, historical chart gallery, I don't know if you knew this, but you can actually look at deep history of different asset classes, and they go back really far. So this is the 30-year treasury yield going back to the 1943. And what's interesting about this chart, just to wrap up the mailbag and hopefully to keep answering your question, I'm always looking for themes and signals that people are underprepared for. We've had this 30-year plus bull market in bonds, downtrend in interest rates. If and when that reverses higher, which is what the chart you asked about would potentially suggest, I think that's a scenario that most investors have actually not experienced, literally not experienced yet. And that is an intriguing potential outcome for me. Great questions, everyone, and thank you so much. We need to wrap up the show. Go right to the 3 and 3. Here we go. Chart number 1 is the New York Composite Index, the NYA. It looks a lot like the financial sector in that it tested the 200-day and failed. And Thursday, before Thursday, you saw it try to close above and then come back down. I have a couple Fibonacci retracements that I took looking at this entire range from January to March, and then also the March to June rally. And what's interesting is you have this confluence of support a little bit below current levels, and it lines up with some congestion and some resistance that we saw here in April and May. So that's sort of my line in the sand with something like the New York Composite Index to see if we're able to maintain above that. If we would break down through that, that would be a breakthrough support. It would also be a break of the trend line, taking the lows from March and May. Chart number 2 is looking at breadth in the form of the percent of stocks above their 200-day moving average and their 50-day moving average. With the 200-day, it's interesting to see how much that has come down from almost 70% to below 40% just in 2 trading sessions. So I think going into next week, we had a huge spike in positive breadth, now a bit of a pullback. And as we stabilize, what does that tell you next about the future direction going into next week? Finally, our last chart of the day is looking at the advancers and decliners. Yesterday, we had a 95% down day. I measure up and down based on advancers and decliners. 95% decliners yesterday. Today, a much different feel. 80% of stocks closing higher than yesterday. So going into next week, a downtrend is made of a cluster of these types of days. We've had one. Do we get more going into next week? Folks, that's our show, and that's a week. That's wrapping up the week on the Final Bar. I want to thank you so much for joining us every weekday for the Final Bar. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great weekend. See you next week.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.